Many people want to invest, but don't know how, or aren't sure how, don't feel like they have enough knowledge, and don't feel like they know what they're doing. But a key part of investing is time. People feel like they don't have enough time or financial knowledge to invest. They feel like their investment wouldn't be safe and that they don't have the time to learn it or the money to pay someone who already knows what they're doing for them. But investing can be fairly simple. That's what this video is about. Now, let me say at the outset, none of the things I say in this video are specific directives for financial or investing advice. They are things that any investor will have to weigh the risks and their own personal circumstances in order to make the decision that is best for them, knowing that any and all investments come with financial risks involved. So, that being said, though, many people want to invest and want to grow their money over time as long-term investors, but simply don't know how. And I've been in that position myself, and I'm still considering the fact that I am learning these things as well. But the sooner that somebody can learn how to do this, the better off they will be. Now, when someone is at the position where they are ready to invest, I would recommend, in line with Dave Ramsey, that you have $1,000 emergency fund, all debt paid off, and that you have 3 to 6 months of expenses saved up to complete an emergency fund before you start to invest. And also, I'm talking about long-term investing, where the shortest term of investment is based on about 5 years at least. So, one way to invest is to put money into the S&P 500. So, what is the S&P 500? Well, the S&P 500, sometimes just called the S&P, is a stock market index that measures the stock performances of 500 large companies listed on the stock exchange in the United States. So, most people, when they invest, think that the investments have to be in individual stocks or individual companies. Coca-Cola, Disney, McDonald's, Walmart. These names that they recognize. And you can invest in those. There are strategies to do that. However, investing in single stocks means that the stock you've purchased goes along with the rise or fall of that single company. Instead, what someone can do is they can put their money into what are called mutual funds or exchange traded funds, which are ETFs, which are a grouping together of several companies rather than just investing in one. They tend to be a lot more stable because they tend to grow over time in the fact that they are not dependent on one company. Now, the S&P 500 has continued to grow consistently, even in light of what are called black swan events: 9/11, 2008 financial crisis, the 2016-2020 coronavirus. While there are these dips in the market that look a lot bigger if you look at them like today, one day of the market, there are these major, seemingly major ups and downs. 5 days, you look at a month, look at 6 months, and then you look at a year, look at 5 years. 5 years is what I recommend for the shortest version of a long-term investment, or the max. There's a clear upward trend in something like the S&P 500 that grows with stability if people put and leave their money alone, despite the daily, monthly, yearly ups and downs. This is what differentiates investing from gambling, is that there are clear upward trends of growth depending on the investments, unlike gambling, where it is purely on the basis of random chance. So the S&P 500 for beginning investors can be a great place to put your money in because you're investing in 500 companies at once, and it has at least a 5-year track record, actually much more, of stable growth over time. Here's the last 5 years. This is a Vanguard fund, the Vanguard 500 index fund, which is simply a mutual fund which follows right along with the S&P 500, invests in those same companies. And this is a projection. It's actually, I think I said 5 years. It's actually over 20 years of, yes, while it has had these dips, there is a clear upward trend of growth. This Vanguard Index 500 fund goes by the symbol VFIAX. And so this article talks about the fact that the S&P 500 index has become a representation of US stocks in the stock market. And over time, the index typically produces even better returns than actively managed portfolios. An actively managed portfolio is something that is a grouping of stocks, like a mutual fund usually is actively managed, where there's a grouping of stocks that the attempt is to make the investors money by managing the fund. ETFs are usually passively managed and simply follow along with a fund rather than trying to beat a certain index fund. So after looking at it, though, over time, people who simply put their money into the S&P and leave it alone over time often find that their money being invested in that safer and simpler way, find that their money grows even better than actively managed funds. So even though this is a beginner kind of move as far as investing, it is a probably sounder strategy than stuff that becomes much more complex. And over long periods of time, passively holding the index fund often produces better results than actively trading or picking single stocks. So rather than trying to say, okay, I want to invest in Apple, Amazon, Walmart, Coca-Cola, Disney, or trying to have actively playing the market, trying to day trade or trade on a short-term basis and make short money in the short term, which is highly risky, leaving the money alone in a passively held index fund over time that continues to grow on itself, reinvest any dividends that come out of it, and doing that consistently, we'll see in many cases more growth than other funds. And then over long time horizons, the index typically produces better results than actively managed portfolios. So while this is a simple move, and it's a beginner move that anybody can open an account with some banking institution and trading institution like TD Ameritrade and can fairly simply put their money into that type of ETF, exchange traded fund, or mutual fund. While this is a move for beginners, it is a move that can yield consistent and stable growth. So they say this is the reason why an increasing number of investors are turning to index funds and ETFs that simply try to match the performance of this index. And over the last 20 years, which is this index fund represents, what would have happened if you put in money over the last 20 years into the S&P 500, into an S&P 500 index fund that simply just tries to follow along with this? That's all it does. That's what this fund is. You would have seen growth despite 9/11, seen growth over time for the last 20 years, despite the 2008 financial crisis and despite the coronavirus outbreak. But how much growth? Well, instead of even in the midst of these what are called black swan events, people on average would see about an 8.2% amount of growth over 20 years, from 2000 to 2020. The S&P 500 still managed to generate a return of 8.2% with reinvested dividends. Dividends are a regular amount that a certain stock or fund pays out to investors. Now, if you continue to reinvest those, if you had done that for the last 20 years, people would have seen an 8.2% return on their money, which meant their money on average over the years would have grown 8.2% every year, which is pretty good. And so while you can look into mutual funds that outperform the S&P 500, having an ETF or a mutual fund that starts with the S&P 500 can be a simple and likely safer growing investment for beginners. Now, the truth is, as I said at the beginning, that no one can predict with 100% accuracy the S&P 500. You can't predict performance, right? The S&P 500 could theoretically fail tomorrow and never come back. However, the trend over time is that that's not the case. The trend over 1, 5, 10, see, even 1 year, okay, growth is still there. Look at 5 years, growth is still there. And then the max, over 20 years, the growth is still there. So, depends. And instead of responding to these ups and downs over time, if you leave it in for at least 5 years, you can generally see how a fund will perform. These are kind of like on a roller coaster, that the people who get hurt on roller coasters, besides some freak accident, are the people who get out before the ride is over. So, it also helps to look at what other people who are successful at doing this are doing. One of the richest people on the planet, Warren Buffett, follows this strategy. He puts his children's inheritance in an S&P 500 index fund. He explained his own strategy. This is a guy who is an investing and business genius, one of the wealthiest people on the planet. And he follows this strategy. And he puts his children's inheritance on the line because he believes the S&P 500 is going to grow safely and stably. He said he did this because the long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. So he says, look, this simple strategy is one that on the average tends to actually outperform all these more complicated strategies. So title of this article recommends you've got $10,000 and you're ready to be a long-term investor, that following a simple strategy of putting it in an index fund, an ETF, or a mutual fund that follows the S&P 500 and leaving it alone for 20 years is likely to be a sound strategy that will produce consistent and stable returns on that investment.